Hi there, it's Friday the 1st of November 2019. I'm Steve Towers. Welcome to ITB. Let's get started. As you know, the last ITB show was on the 18th of October, which is 2 weeks ago. There are a number of important stories which emerged during the first week. I've included those stories in today's show, but to distinguish them from this week's stories, they're marked as catch-up stories on the relevant slides. And also, I should apologise for the state of my voice. Too much Halloween last night. In the last 2 weeks, there's been a lot of public discussion of the OECD Secretariat's unified approach to Pillar 1. Some folks like the proposed profit allocation rules, for example, the Irish government, while others don't, for example, the G24 countries. Some folks like the proposed mandatory binding arbitration, for example, US business groups, while others reject it, for example, most developing countries. But I think the most important insights provided in the last 2 weeks are by Pascal Saint-Amand in regard to the issue of consensus. He said that unanimous support from the 134 countries in the inclusive framework will not be required. Now, we are pragmatic. If you have all the big guys and a significant chunk of the small guys saying, yes, we do it, then the thing happens. Everyone must be involved, though. He also said that the 134 countries can be grouped with other countries with similar interests. For example, wealthy countries, small exporting countries, investment hubs, developing countries, and so on. If one group in its entirety says, sorry, we don't go, it is going to be hard. But if only one country in a group objects, the project will proceed, which sounds to me like a roadmap for the investment hubs, which stand to lose significant tax base, to frustrate the project. Turkey has become the latest country to announce the introduction of a digital services tax. A draft bill was released by the government on the 24th of October. There are 2 revenue thresholds for the application of the DST. Global group revenue of 750 million euros and group revenue from Turkey of 20 million lira. The DST would apply to a wide range of digital services, and it would be imposed at the eye-popping rate of 7.5%, with the President having power to vary the rate on specific services to as low as 1% or as high as 15%. The DST would be effective 3 months after the DST law is announced in the official Gazette. For a copy of the draft bill, please go to our website or app. Let me give you a quick roundup of other recent developments in regard to DSTs. Austria has enacted its 5% digital advertising tax, which will commence on the 1st of January 2020. In Italy, the government included a 3% DST in its 2020 budget package to commence on the 1st of January 2020. And in Canada, the ruling Liberal Party has won government in the recent general election, and a 3% DST to commence on the 1st of April 2020 was part of its campaign platform. The EU has threatened to impose tariffs on imports from the US in retaliation against the US tariffs which were introduced on the 18th of October. This tit for tat is in regard to the recent WTO ruling concerning subsidies for Airbus. For a copy of the statement issued by the EU's Commissioner for Trade, please go to our website or app. Meanwhile, in the China-US trade war, the two countries are still writing up the formal version of the Phase 1 agreement, which was agreed in principle in mid-October. But they will have to find another venue to sign the agreement. Chile has announced this week that the APEC meeting has been cancelled due to the civil unrest in the country. And the US has been successful in a WTO dispute with India concerning subsidies to Indian exporters worth over $7 billion annually. The US Trade Representative has issued a statement on this win. For a copy of this statement, please go to our website or app. The OECD has released guidance on the spontaneous exchange of information by no or only nominal tax jurisdictions in regard to the new substantial activity standard. For a copy of the guidance, please go to our website or app. The OECD has released the 6th batch of peer review reports on BEPS Action 14 concerning the MAP process. The 6th batch covers 8 countries: Argentina, Chile, Colombia, Croatia, India, Latvia, Lithuania, and South Africa. 3 of the countries missed the Action 14 minimum standard by a large margin: Colombia, India, and Latvia. Not surprisingly, India's MAP inventory is easily the highest amongst the 8 countries. At the end of the 2016-2017 period, India had an MAP inventory of 763 cases, with an average closure time of 35.7 months. For a copy of the 8 peer review reports, please go to our website or app. The UN Committee of Tax Experts had its most recent meeting on the 15th to 18th of October. The highlight of the meeting was the presentation by the Transfer Pricing Subcommittee of its proposed changes to the UN Transfer Pricing Manual for developing countries. There's 160 pages of changes on 6 topics, which I've listed here. Please hit the pause button if you'd like to study this list. For a copy of the proposed changes, please go to our website or app. In Australia, the tax authorities have issued for public comment draft guidance in regard to the calculation of the foreign tax credit limitation under domestic law. In particular, the draft guidance expresses the view that a capital gain on which no foreign tax is paid cannot be included in the calculation of the limitation. Public comments are requested by the 8th of November. For a copy of the draft guidance, please go to our website or app. And also in Australia, the tax authorities have announced that due to the recent enactment of retrospective amendments to Australia's thin cap rules, taxpayers will be given 3 months to amend their previously filed tax returns to comply with the new rules. And if they do so within that time, no penalties will be imposed. For a copy of the announcement, please go to our website or app. And Australia now has its first court decision on the non-discrimination article in double tax treaties. It's taken a long time for this to occur because for many years, Australia's treaty policy was not to include a non-discrimination article. The case concerns the Australia-UK Treaty, and it focuses on a special tax rate under Australian income tax law which applies to foreign citizens with working holiday visas. The court held that the special tax rate was a form of discrimination based on nationality, and it was therefore in breach of the provision which corresponds to Article 24.1 of the OECD Model Treaty. For a copy of this case, please go to our website or app. In China, the tax authorities have issued new guidance in regard to the claiming of benefits under China's double tax treaties. The new guidance, announcement number 35 of 2019, will replace the previous guidance, announcement number 60 of 2015, effective the 1st of January 2020. Announcement 35 provides some good news in regard to the practical aspects of achieving treaty benefits. For example, the Chinese payer will be permitted to withhold tax at the treaty rate if the non-residence relief form has been fully filled out. It will no longer have to verify the accuracy of the assertions made by the non-resident. For a copy of Announcement 35, please go to our website or app. I have two cases from India for you. The first case is called La Maya. It's a decision of the Delhi Income Tax Appellate Tribunal, and it concerns the Business Profits Article, Article 7 of the India-Germany Treaty. The taxpayer is a German resident company which provides engineering consulting services. During the relevant year, the taxpayer provided such services in regard to 10 power plant projects in India, under contracts made with various state governments and related bodies. In regard to one of those projects, the taxpayer opened a project office in India. For that particular project, the taxpayer provided its services via employees based at the project office. For all of the other projects, the services were provided from outside India. The taxpayer accepted that the project office qualified as a PE under the India-Germany Treaty, and therefore the fees for the services provided through that office were taxable in India under Article 7. However, in regard to all the other projects, the taxpayer claimed that Article 7 did not apply to the relevant service fees. Instead, the taxpayer claimed that these were taxable under the Fees for Technical Services article. Despite the fact that Article 7 requires taxation on a net basis, the tax rate differential was sufficient for the taxpayer to pay less Indian tax under the Fees for Technical Services article. Now, if you look at Article 7.1 of that treaty, you'll see that it's in the same form as Article 7.1 of the OECD Model Treaty. However, Paragraph 2C of the Protocol, which was signed at the same time as the treaty, provides for a modified force of attraction rule. In respect of Article 7.1, profits derived from the sale of goods or merchandise of the same or similar kind as those sold, or from other business activities of the same or similar kind as those effected through that permitted establishment, may be considered attributable to that permitted establishment if it is proved that 1. This transaction has been resorted to in order to avoid taxation in the contracting state where the permitted establishment is situated, and 2. The permitted establishment in any way was involved in this transaction. So this paragraph 2C of the protocol will deem profits to be attributable to the PE if all of three conditions are satisfied. Firstly, the profits are from business activities of the same or similar kind as those effected through the PE. Secondly, the transaction was resorted to in order to avoid taxation in the source country. And thirdly, the PE was in any way involved in the transaction. The Indian tax authorities claimed that all three conditions were satisfied in this case. But the tribunal disagreed. It held that the tax authorities had not proven the satisfaction of either the second condition, that the transaction was resorted to in order to avoid Indian taxation, or the third condition, that the PE was in any way involved in the transaction. For a copy of this case, please go to our website or app. The second case from India is called Voltus. It's a decision of the Mumbai Income Tax Appellate Tribunal, and it concerns a transfer pricing adjustment involving imputed interest. This is another of those cases where an Indian resident shareholder sends cash to a non-resident company to subscribe for shares, and there's a long delay until the shares are finally issued to the shareholder. In such cases, the Indian tax authorities frequently claim that the transfer of cash should be treated for transfer pricing purposes as an interest-free loan, and therefore arm's length interest can be imputed. That's exactly what happened in this case. But what's remarkable about this case is the length of the delay, 6 years. According to the facts, this delay was largely due to a delay in obtaining regulatory approval in Saudi Arabia for the share issue. Nevertheless, the tribunal accepted the taxpayer's argument that this delay was not intended and that the share subscription transaction was not a sham. And on that basis, the tribunal held that if it's not a sham, it's not a loan. And if it's not a loan, interest cannot be imputed. For a copy of this case, please go to our website or app. In Singapore, the tax authorities have issued updated versions of 2 items of guidance. The first is on the income tax treatment of REITs, and the second is on the income tax treatment of hybrid instruments. For a copy of these 2 updated items of guidance, please go to our website or app. In Denmark, a court has decided an interesting transfer pricing case. Although the official report of the case keeps the identity of the taxpayer group confidential, one commentator has stated that the facts in the case point to it being the Adecco group. The taxpayer is a Danish subsidiary within a group which operates one of the world's largest temporary and permanent staffing businesses. The taxpayer paid royalties to the Swiss group parent. The royalties were for the use of trademarks and trade names, know-how, international network intangibles, and business concept. 2 royalty rates were paid. Firstly, a royalty of 4% per annum on the taxpayer's professional staffing revenue. And secondly, a royalty of 2% per annum on the taxpayer's office and industrial staffing revenue. The taxpayer's transfer pricing documentation supported these 2 rates by both an internal CUP and external CUP analysis. The internal CUP analysis was based on franchise agreements between US group companies and third parties, and the external CUP analysis was based on commercial databases. After comparability adjustments, the 2% and 4% rates fell within the arm's length range determined from the 2 types of CUP analysis. However, the Danish tax authorities reduced the 2 royalty rates to 0, and the court agreed for several reasons. Firstly, the taxpayer had a very long history of losses. Secondly, the franchise agreements in the US were quite different from the agreement between the Danish taxpayer and the Swiss parent, and the franchise agreements in the commercial databases were not shown to be sufficiently similar. Thirdly, there are major differences between the Danish market and the markets from which the comparables were taken. Fourthly, the taxpayer incurred significant marketing costs. And finally, due to its inadequate transfer pricing documentation, the burden of proof was on the taxpayer, which it failed to discharge. For a copy of this case, please go to our website or app. In Germany, the government has announced that the proposed amendments to the real estate transfer tax, RET, will be delayed until the first half of 2020. The delay is in response to suggested changes which were given to the government in a public consultation on the 14th of October. The effective date for the proposed amendments was originally set as the 1st of January 2020. The government has not indicated whether the effective date will also be delayed or whether the amendments, when finally legislated, will be made retrospective from that date. In Italy, the tax authorities have released guidance in regard to the domestic law exemption from interest withholding tax on qualifying loans borrowed from banks established in other EU member states. The particular issue dealt with in the guidance is the impact, if any, on the exemption if the original lender enters into a sub-participation agreement with another company which is also established in an EU member state. The short answer is no impact. For a copy of the guidance, please go to our website or app. In Argentina, the government has published the regulations for the so-called knowledge economy regime, which offers several benefits, including a reduced income tax rate of 15%. The regime is effective on the 1st of January 2020 for a period of 10 years. For a copy of the regulations, please go to our website or app. And as I'm sure you know, Argentina has this week elected a new president, Alberto Fernandez, and a former president, Cristina Fernandez de Kirchner, has been elected as vice president. The new president-elect has not indicated the details of his tax policy, but with the country's severe economic hardship and the existing $57 billion line of credit from the IMF, the key issue, I think, is what tax policy the IMF will allow or require. In Brazil, the tax authorities have issued important guidance on 2 social security levies. The new guidance consolidates many previous rulings and also addresses the calculation of the tax base for the 2 levies. For a copy of the guidance, please go to our website or app. And going against the global trend, Brazil's government has announced that it wants to remove the existing levy of $18 on international flights in order to encourage more air travel by low-cost airlines. In Colombia, the Constitutional Court has held that the 2018 tax reform legislation is unconstitutional because of defects in the procedures in Congress. However, the legislation will remain valid until the 31st of December 2019, at which point it will no longer apply, with the consequence that the previous law will then operate from the 1st of January 2020. However, the government is trying to rescue the situation by introducing last week a new but similar bill into Congress. In Ecuador, the government has introduced into Parliament a major tax reform bill, with the changes to be generally effective on the 1st of January 2020. Several items caught my eye. Firstly, in regard to foreign source income, Ecuador will move from an exemption system to a credit system. Under current law, foreign source income of a resident company which has been taxed in another jurisdiction is generally exempt from Ecuadorian tax. Under the amendment, the foreign source income will be taxable in Ecuador with a foreign tax credit for the foreign tax. For companies outside the financial sector, a restriction on deductibility of interest, set at 20% of EBITDA, will be introduced. The bill proposes to restrict several other deductions. One that caught my eye concerns the allocation of indirect expenses by related parties. Under current law, there's a cap on the deduction of such expenses. Under the amendment, they will be wholly non-deductible. A temporary additional tax will be imposed on companies with annual gross revenue exceeding $1 million. Importantly, the tax will be imposed on gross revenue, not on taxable profits. The tax rate will range between 0.1% and 0.2%, but the additional tax will be capped at 25% of the company's tax liability for the 2018 year. The additional tax will apply only in 2020, 2021 and 2022. The bill will introduce a dividend withholding tax at an effective rate of 10% on dividends paid by resident companies to non-resident companies. Under current law, such dividends are generally exempt from withholding tax. And VAT will be imposed on inbound digital services at the standard 12% rate. Credit card companies will act as withholding agents to collect the tax. In the US, the tax court has decided a strange transfer pricing case. The taxpayer is Eaton, which you might remember won an important case in 2017 in regard to the IRS's cancellation of its APA. In that case, the court held that the cancellation of the APA was invalid. As a result of that 2017 case, the IRS's purported transfer pricing adjustments under Section 482 were also invalid. Despite that fact, the IRS nevertheless proceeded to impose penalties on the taxpayer. In this week's case, the tax court, as you would expect, declared those penalties to be invalid. For a copy of this recent case, please go to our website or app. And the US Treasury and IRS have released two documents in regard to the Section 385 debt versus equity characterization rules. The first document removes the 2016 final regulations on documentation requirements under Section 385. And the second document is an advance notice that proposed regulations will be issued in regard to Section 385. For a copy of both documents, please go to our website or app. And now for this week's treaty developments. We've had 2 treaties signed, 1 protocol signed, 1 treaty enter into force, and 1 protocol enter into force. Now, here's a curiosity. The recently signed France-Luxembourg Protocol has an interesting way of providing an exemption. It's disguised as a credit. For French residents who derive employment income in Luxembourg, the protocol requires France to give a credit equal to the French tax on that income, provided the income has been subject to Luxembourg tax. This is effectively an exemption with progression method. Well, that's the way it is this Friday, the 1st of November 2019. I'm Steve Towers. Have a great weekend.